Amazon just increased its spending plan to an unbelievable $220 billion. Free cash flow is already negative, and next quarter guidance came below the Wall Street expectations. Normally, that combination should punish a stock, but instead, Amazon shares surged sharply after the results. And question is why? Because this quarter may be the strongest evidence yet that Amazon's enormous AI investment is beginning to work. But the evidence is not complete, and one number could still break the entire thesis. Amazon delivered a broad revenue and margin beat, but that was not the real story. The surprise was AWS delivering much faster growth and significant stronger profitability than Wall Street expected. The combination changed the investment narrative. AWS has now accelerated for 5 consecutive quarters. This was its fastest growth in 18 quarters, even though AWS is now more than twice as large as it was the last time it grew this quickly. AWS also added more than 4.6 billion of revenue sequentially, but growth was only half the surprise. And another surprise is operating margin of the AWS that reached approximately 39% versus a street estimate of 34%. That directly challenges the bear argument that AI infrastructure can generate strong revenue growth only at the cost of weaker profitability. Amazon just provided evidence that AI growth and attractive AWS margin can coexist together. So, what is driving this acceleration? Amazon disclosed 2 important milestones. AWS's AI-related business has exceeded a 25 billion ARR annual revenue run rate, growing at triple-digit percentage. Separately, Amazon chip business has also crossed a 25 billion ARR, up more than 20 billion in previous quarter. These figures should not simply be added because this category may overlap, and Amazon is not selling 25 billion of physical chips. It primarily monetizes Trainium, Graviton through AWS compute services. Anthropic and OpenAI have made multi-year and multi-gigawatt commitments to Trainium, while Graviton is used by 98% of AWS's top EC2 customers. But here is the real flywheel. AI applications do not run only on expensive accelerators. Post-training, reinforcement learning, and agent tools call also use CPUs. AI data requires storage, database, and vector search infrastructure. So every new AI workload can pull additional demand across Amazon's traditional cloud services. Bedrock reinforces that argument. Customer spending on Bedrock during this quarter exceeded all the previous quarters combined. Amazon is also moving up the application stack through Cairo, Amazon Q, and AWS Continuum. But without disclosed revenue, I would currently treat them as future optionality. Then the CEO Andy Jassy made the boldest statement of the conference call. AWS is currently operating at an approximate $169 billion ARR. But management believes it could eventually become a $1 trillion ARR business. This is an aspiration and not the formal guidance, and Amazon provided no timeline. And Jassy's argument is that around 85% of global IT spending still remains on premises, leaving a potentially long runway for cloud and AI migration. And AWS is not Amazon's only emerging infra opportunity. Amazon's Leo now has close to 400 satellites in orbit, enough to begin initial satellite internet services this year. Management says it has already meaningful enterprise and government revenue commitments, plus more than 20 global distribution partners. Leo remains early, but it could eventually become another recurring infrastructure business. And the bigger question is, what Amazon must spend to capture all these opportunities? Amazon raised expected 2026 cash CapEx from approximately 200 billion to 220 billion, mainly because of higher memory and other component cost. Even after spending that amount, management says Amazon may still lack enough capacity to meet demand through 2027. That sounds bullish, but it is also management defending record spending. So let's examine the economics. Amazon begins spending on a data center around 2 years before it generates revenue. That damages the present cash flow because the investment occurs long before monetization. But once operational, management believes that data center can generate revenue far more than the 30 years and hosts 5 or 6 generations of servers. Servers follow a shorter cycle. Amazon normally buys them only a few months before deployment, when it has greater visibility of customer demand. Management says server and network investments break even in slightly under 3 years, remaining useful for at least 5 to 6 years, and most AI capacity is contracted for at least 5 years. That model is attractive, but only if utilization remains high. Amazon does have substantial demand visibility. AWS backlog has reached $496 billion. Most of the capacity being added for 2027 is already reserved, and meaningful capacity committed for 2028. But backlog is not a guaranteed profit. Returns could still weaken by hardware obsolescence, electricity cost, component inflation, or pricing competitions. Long-term contracts also create a trade-off. They protect demand, but Amazon cannot automatically reprice an existing contract when its input cost rises. Therefore, the backlog materially reduces demand risk, but not return on capital risk. The most important risk is free cash flow. Amazon's trailing free cash flow moved from positive 18.2 billion to an outflow of 7.6 billion, primarily because of its infrastructure build-out. Management calls this as a timing mismatch. Amazon is spending today on data centers that may not generate revenue in near term, but in longer term, this will generate revenue. This argument is reasonable, but the timing of the recovery remains uncertain. If AWS maintains a strong growth until this new capacity begins generating revenue, this investment could produce attractive returns. If AWS slows before CapEx does, the market view could change very quickly. One quick accounting note: headline EPS was inflated by an Anthropic valuation gain, while operating income included approximately 1.2 billion of tariff refunded and energy derivative contract benefits. So the normalized operating performance matters more than the reported EPS. Outside AWS, retail benefited from Prime Day advertising modestly beat expectations, and although Q3 guidance came below the street, the shift of Prime Day into Q2 make the outlook weak than the headline suggests. Here is my conclusion. This quarter provided the strongest evidence so far that Amazon's AI investment is producing real revenue growth and attractive AWS margins. AWS accelerated sharply on an enormous revenue base. The AI and custom silicon business reached meaningful scale, and the backlog gives Amazon unusually strong visibility before it deploys additional capital. That explains the market's bullish reaction. But this is not yet complete proof that $220 billion of capex will generate attractive long-term returns. The Amazon thesis now depends on three tests. 1. Can AWS sustain elevated growth as new capacity comes online? 2. Can AWS preserve a strong margin as AI becomes a larger part of its revenue mix? And third and last, when does free cash flow begin to recover? Operationally, this was an excellent quarter and a meaningful upgrade to Amazon's AI thesis. But the real test is whether today's historic spending eventually converts into a durable free cash flow and a good ROIC. The market is betting that Amazon is not building a speculative capacity, it is building for demand that already exists. If management is right, this investment cycle could deepen Amazon's competitive moat, and the $1 trillion AWS ambition may not be unrealistic as it initially sounds. If management is wrong, this becomes one of the largest capital allocation risks in technology. Do you believe AWS can eventually become $1 trillion business? Or is the market underestimating the cost of getting there? Please share your view in the comments, and for research-driven stock analysis beyond the headlines, subscribe to Bhagat Capital. Thank you.